Welcome back to day 4 in the Six Figure Capital 14-day course. Today's module is You Are the Trader. Today we're going to be organising your trading to suit your lifestyle, career and future prospects. Now in today's module we will be going over identifying your trading personality, followed by 3 types of analysis, and finally trading journal. Now in day 3 we learned that currencies are either quoted to 3 or 5 decimal places. So for Japanese yen pairs, this is 3 decimal points or 3 decimal places. And for Great Britain pound US dollar or euro US dollar and currency pairs of that nature, most of your majors and minors, these are quoted at 5 decimal places. Now we also learned that if you're buying, you expect the exchange rate to increase. So if you're going long in the market, which would be bullish. So if you're going long or buying, you expect the exchange rate to increase, therefore you'd make profit. And if you're selling, which would be going short, you expect the exchange rate to decrease. We also learned that pips is a unit of measurement used to express the difference in exchange rate, and simply put, pips equal profit. And finally, unit and lot sizes, these are used to calculate the value per pip, which determine the value of our positions. Now moving on to today's module, our first topic is identifying your trading personality. And when you're trading, there are what I would like to say 4 different types of traders. The first one is a scalper. So they open and close trades within minutes. They are quite similar to a day trader, just a similar sort of style. So a scalper open and closes trades within minutes, and they take advantage of small price movements. And the main time frames they trade on is 1 minute, 5 minute and 15 minute. A day trader, so as I said, similar to a scalper, except they trade longer time frames, all positions are closed before the trading day is over. So you can see a relation between these 2 types. They literally trade for a living. They trade every single day that the market is open. They're always trading. So they don't want the exposure of holding trades overnight. And this will make sense when we go into the next type of trader. And the main time frames they will focus on typically is 5 minute, 15 minute and 30 minute. They may look at the 1 hour chart as well. Now our third type is a swing trader. Now I'm a swing trader, and a swing trader holds positions for several days or weeks before closing. They take advantage of larger price movements, and the main time frames are 1 hour, 4 hour and daily. Sometimes as low as the 30 minute or 15 minute for entering different trading positions. Now as mentioned, they will hold trades for several days or weeks. Now if you imagine as a day trader, you close all of your trading positions before the day is over. So you get up at 8 AM or 7 AM, whatever time you get up, you place your positions, you go to work, you manage them during the day, and you close them before you go to bed every single day. That's a lot of work. It is a lot of work being a day trader. I used to day trade in the past, and it was actually one of the main mistakes that I made. I just assumed that it was the best way to go. I didn't actually realize that you had an option. And actually, swing trading, as soon as I made the switch over to swing trading, my trading completely changed for the better. And I'm not saying that swing trading is better than being a scalper, day trader, or what I'm about to mention, the next type. I'm just saying it was best suited to me. And the last type is a position trader. So this is a long-term style of trading. For many of you, if not 99% of you doing the 14-day course at Six Figure Capital, you will not become a position trader. So a position trader holds positions for several months or years. This type of analysis or analyst frequently incorporates fundamental data to capitalize on emerging trends. Now, fundamental data is news releases, and we'll go on to that in the next topic. And the main time frames are typically the daily, weekly, and monthly. Now, this will all make sense when we're talking about time frames. When we go into day 5 and day 6, you'll understand what I mean by trading time frames. Now, moving on to our second topic for today, which is 3 types of analysis. Now, let's take your first step in market analysis, and this is how you essentially capitalize on price movements and make profit. So as mentioned, there are 3 types of analysis, 3 main types. These are technical analysis, fundamental analysis, and sentiment analysis. And we'll cover each type individually, starting off with technical. Now, we are technical traders, or you will become a technical trader by the end of the 14-day course. And a technical trader uses the framework, or it is the framework in which a trader bases their analysis on historical price movements. So everything you do is based on what has already happened. And this is a quote I absolutely love. Price is a collective record of buying and selling over time. That's all it is. It's a collective record of buying and selling over time. Now, we can use that record to predict future price movements. So, as I always say, history tends to repeat itself. We can use a specific measured approach based on what has already happened to predict what will happen in the future. And this is what technical analysis is all about. Now, the amount of strategies that comes with this, when it comes to technical analysis, there are thousands of different strategies, most of which are unsuccessful. So finding a successful strategy that has stood the test of time is, of course, very, very important. And that's why you're here doing the Six Figure Capital course. And you'll learn more about our strategy when you get into day 7 and beyond. Now, the second type of analysis, which is fundamental analysis, this is based upon economic, financial, and quantitative factors. Now, the fundamental analyst will study how economic data affects the global financial markets. And the stronger the country's economy, the stronger the country's currency. If an economy is strong, it will attract foreign investments and encourage more business. So the news events occur on a daily basis. As mentioned before, fundamental analysis is based on news releases. And these are filtered by level of importance and their impact on the market, which has low impact. So when these are released, there's typically not a lot of movement in the market. Whenever this hits the market, there's not a lot of movement. You have medium. Now, these do have a slight amount of impact in the market. You will see the exchange rate move in either direction, and it will have and the next type, which is high, will have a significant impact, which is high. So these are your major news events, as I should say, and these are the ones that you really want to focus on. So when we're trading a technical based strategy, which is based on price history, which is a collective record of buying and selling over time, so the market activity, this of course is can be interrupted by fundamental data. So we need to keep track of these news events. So let's take a look at the main types. First of all, interest rates. Now, I would say these are definitely in the top 3. Whenever an interest rate statement comes out, let's say the interest rate is increased or decreased, you will see a major impact on the markets. And this can, of course, have a positive or negative influence on your current trading position. Employment and unemployment rates, gross domestic product, which is known as GDP, housing data, consumer price index, which is CPI, and producer price index, which is PPI. Now, there are many, many other types of fundamental releases. These are just the main ones to note that I would focus on. There is also something known as NFP, which is non-farm payrolls. This is the first Friday of every single month, and this is based on the US dollar. And this can sometimes affect the entire market. So again, trading the first Friday of every month, some people just avoid that day completely. It's just not a trading day for most people. Others, on the other hand, they'll use that day to capitalize on these extremely volatile price movements. Now again, you can see how important this is to keep track of fundamental releases. You don't want to be in a trading position and then 1 hour later there's a news event that you didn't know about and it completely changes the direction of your trade and you end up in a loss. So it's extremely important to make sure that you know what fundamental data is coming out ahead of time. So we use something called an economic calendar. These can be found on pretty much every single trading platform or investing website that you use. The main ones would be Forex Factory, Daily FX. These all have economic calendars. When we go into day 6, I will show you the economic calendar that I use. Now onto our third type of analysis, and this one is less frequently used, and it is sentiment analysis. So this is analysing the market mood based on current activity. So price history represents what all traders felt about the market at that given time. So as I said before, it is a collective record of buying and selling. Therefore, it is a record of what traders felt about the market at that given time, whether they bought or sold. Each trader's thoughts or opinions expressed through their trading positions form the overall sentiment of the market. Sentiment analysis helps identify the underlying feeling towards an asset, and this applies to all markets on all time frames. Now, my advice. What is my advice? That's what you want to know, and it truly just comes down to you as an individual. Today's module is all about who you are as a trader and just making sure that you fit in the puzzle, finding your place. Are you going to be a scalper, a day trader, a swing trader, or position trader? And I can tell you right now, the majority of people here will definitely become a swing trader. If you have a day job, which most of you will have, then swing trading is most suited to you. I can tell you that right now. When I very first started trading, of course, having a day job, every single time I placed a position, I was panicking when I was at my work. I would place my trades either the night before or in the morning before work. I would go to work knowing I had my position in place, sometimes over risking. That's something that new traders do, if not all new traders that are going the route of being self-educated. And I would be looking at my phone pretty much the entire day. I would be watching the pips move, as we would say. Literally watching the exchange rate move up and down, in and out of profit all day. And I'll tell you, it's extremely stressful, and I know a lot of people do it. Some of you here probably have done it in the past, and I know how it feels. And when you've got a day job, day trading or scalping is extremely stressful. Now, if you're someone that can deal with that, then by all means, that may be suited to you. You could become a scalper or a day trader. But for most people, they don't have the time to become a day trader. Unless you work part-time or you don't work many hours per day. But for those working a 9 to 5, day trading is probably not suited to you. Swing trading, my advice would be swing trading is probably your best option if you've got a day job. And even if once you go full-time in trading, swing trading, it provides more time freedom. At the end of the day, we trade to have more time. We trade to be financially free. And once you become financially free, of course, you don't want to be sat at your trading desk all day trading for a living. Of course, you want to have, again, time freedom. You want to be able to spend your time as you please, and that's something that swing trading provides. Of course, you're not having to look at your positions every single minute of the day. You can place your position at 2 p.m. on a Thursday. You can leave it Friday. You can monitor it on Friday just before the market closes. You can leave it Saturday, Sunday, come back on Sunday night or Monday morning to check your position, and it might be halfway towards your profit target. And you can leave it until the following Friday, and then your position is closed. How much more relaxing is that? How much more hands-off is that in comparison to placing a trade on the Thursday at 2 p.m., you start work at 4 p.m., you have to get, an early lunch so you can check your position at 6 p.m. You know fine well you're not going to be holding it past midnight. You get home from work maybe at 10 p.m. and you're just looking at your position pretty much the entire day, and you're rushing about trying to get it closed, and you're making sure that it's in profit. You're making sure that you're managing your position, your stop loss. You're managing your stop loss to limit risk. It's an extremely stressful game if you're working full time. So my advice would be that you select a trading personality that suits you. And for most of you, that will definitely be swing trading. Now on to our final topic for today, which is trading journal. Now this is an extremely important part of trading, probably the most overlooked aspect in trading, yet the best tool for progression. Journaling allows you to see what you're doing right, but also what you're doing wrong. Therefore, it provides the best teaching experience available, which is your own mistakes. And this will fine-tune your trading. So not only can you find out what's working with your trading plan, You can also find out what's going wrong. So it will keep you on track. So many people ask me, what should I include in my trading journal? What is the main things I should note down? Well, of course, the asset you're trading. So if you're trading Great Britain pound US dollar, you should have that noted down. Because let's say you're trading Great Britain pound US dollar and you've traded that 10 times, but maybe 5 or 6 times you've lost those positions. You can then figure out why it's not working. You may have another asset that you're trading, such as Great Britain pound Japanese yen, and you had 10 trades, but all of those were profitable positions. You made profit on every single trade. You can then figure out what's working and compare that to Great Britain pound US dollar and find out why it's not working. The entry price and exit price. So what price did you get into the trade, the exchange rate, and what was the exit price, so the exchange rate when you closed your position. The position size and risk percentage, again, we'll cover these in later modules, but the position size, of course, is calculated based on your unit and lot size, and the risk percentage is always 1 to 2%. Trade management rules, again, we'll cover these in later modules, and then the summary of your position. What happened? Was there any interference with the position? Did you close it early? Did you let it run until it hit your final take profit target? What happened? Always write a summary of your position so you can go back and reflect on what you've done the previous week, the previous month, and even 3 months prior, 3 months back, you can even look at what happened in your different trading positions. So like I said, you can compare all of your positions for Great Britain pound US dollar, or all of them for even just Japanese yen pairs. You can compare all of those positions and see exactly what happens. So it makes you measurable. Now, I've included in this module 2 trading journals, a trading journal PDF, which is the one on the left-hand side, a very basic PDF. You can print this off. You can print off 100 copies if you want and keep them as a booklet. And you can just keep this on your trading desk. And by now, you know, your trading desk is going to be mounting up with paperwork with all the ebooks you've got. But you can keep this on your trading desk. It's very easy. You can fill it out, pen and paper. Or we have an electronic version, which is the Excel, Trading Journal Excel. Again, you could print this off if you please, but it's probably easier if you use this whilst trading and had it open at the same time. So you can find both of these below today's module, Trading Journal PDF and Trading Journal Excel. What I'm going to do is going to walk through both of those individually, just giving you an example of how to use them so you can get the most out of your trading journal. Alright, so here we have the Trading Journal PDF, and I don't want to insult your intelligence at all because it is very simple and straightforward, but I want to make sure that you understand how to fill this out. So you have the open date and time. This is the time you opened, on date you opened the position. The trading asset, which could be Forex, commodities, stocks, cryptocurrencies, derivatives, whatever it may be, whatever you're trading goes in this section. You have the strategy, which you'll learn later on in the 14-day course, and this may be a bullish bat or a bullish crab. You can insert this pattern or strategy in this section. You have the entry price, you have the stop price, which is the stop loss, the limit price, which is the take profit, the unit and lot size used, so this may be 10,000 units, or it could be one lot, or 0.1 lot. The risk to reward ratio, the percentage risk, which is 1 to 2%, and the date and time you closed the trade, and whether it resulted in a profit or loss. Very straightforward. And then of course I've left a big section at the bottom there to write your own notes. So a summary of the position, what happened. So again, like I said, it's very straightforward. I just want to make sure you understand how to use it. And you can print this off, you can make your own booklet, or like mentioned, you can use the Excel version and keep an electronic copy. So what we're going to do is we're going to walk through the Excel version now. If we just switch over. So here we have the Trading Journal Excel. It's the exact same as the PDF. Of course, you've just got an electronic version. So you just work from left to right. You've got the open date, open time, trading asset, strategy used, entry price, and so on. And then again at the very end here, you have the summary. And you can literally keep a record of all your trading positions in here. I just wanted to make a very simple trading journal for you guys to use. Of course, you can look into trading journal packages in the future, which we will talk about in later courses. And again, you can use something like MyFXBook if this is something that interests you. But just for starting out, you can get used to just using the PDF and Excel journal. So let's head back to finish off the rest of day 4. Moving on to rookie mistake number 4 for today. These are real trading mistakes that cost me a considerable amount of time and money. You guys get the gist by now. Today's rookie mistake is not being measurable. And this relates to keeping a trading journal. I know that tracking every trading position can be extremely tedious, especially during the early stages of trading. It's not a pleasant task for most people. However, this is essential to your trading success. And it really just comes down to following the system. I see many people, it might not even relate to Six Figure Capital, but other courses for that matter, where they'll pick out the best parts, what they consider the best parts, and they won't use all of the information provided. So they'll pick out what they feel is the best parts, and what you're essentially doing in that situation is you are changing a working system. So you're just picking out what you feel is the best, and you're combining it with your own strategy or your own knowledge, and then you're trying to mix up a different system, and what you're doing is you're changing out a working system entirely rather than following it step by step. Such as the 14-day course, every single step of trading is laid out within 14 days. So by the end of the 14-day course, you can confidently open a trading account and start trading. Of course, we've got the Harmonic Mastery course, which follows that to help, of course, develop you on a more advanced level as a trader. But the 14-day course, that is it in a nutshell. So it's everything that I do on a day-to-day basis in my trading career. Whereas if you're picking out the best parts, such as, let's say you didn't keep a trading journal, you're then changing a working system. And trust me on this, if you keep a trading journal, it will fast track your performance as a trader. As mentioned before, many times, it will show you what you're doing right, but also what you're doing wrong. Now, on average, it takes 66 days for a new habit to become automatic. So make it a habit, make it a goal of yours for every single time you open a trade and exit a trade, you log the trade. You summarize it and you explain exactly what happened, positive or negative. Now, a trading journal will help identify potentially bad trading habits before they fully develop and become natural. So like I said, it takes 66 days for a new habit to become automatic on average. I didn't say they were good habits. These could be bad habits as well. So let's say, for instance, you are a trader who has been trading for 6 months and you didn't keep a trading journal. Now, throughout those 6 months, a bad habit started to form, and over maybe a 1 to 4 month period, that bad habit started to become automatic. And it happened over and over and over again. Now, at this point, you're a losing trader, but you can't actually figure out why you're losing trades. You may have blown an account previously, or you may be a profitable trader, but you're not making much profit. And again, it tends to come down to bad trading habits or something that you may be doing wrong, which could, most of the time, it's just a simple correction. Whereas if you were keeping a trading journal, it will not only help you identify these bad trading habits, but eliminate them completely so you can advance as a trader. So you can see why it's extremely important to keep a trading journal, although it may be inconvenient, but again, that's what it takes to become successful. Do what others won't. So when you're keeping a trading journal, the ones I've provided, the PDF and Excel, they're very basic versions. Again, you can use something like MyFXBook, which is automated. You can make it private as well. You can also use something like an automated software. There are many out there, but for now, you're in the early stages. Keep it simple. Use the manual journals that I've provided. So let's just wrap it up for today. It's been a short module, but extremely educational. And the main point of today's module was to develop a trading personality that suits your lifestyle. So again, as mentioned, you can become a scalper, day trader, swing trader, or position trader. It's entirely your choice. For most of you, swing trading will be best suited. So if you've got a day job, I don't know you personally at the moment, but I will. I'll do my best to get to know everyone within Six Figure Capital. You may have a day job. You may work back shift. You may work night shift. I don't know you at the moment. So it's up to you to select your trading personality, whatever suits you best. Now, it doesn't mean if you become a swing trader, you can't then become a scalper in the future or a day trader. By all means, you can switch, but what I would tell you right now is don't chop and change whenever you please. So what I don't want to see is someone that's a swing trader is then taking a position on the 5-minute chart one day, and then the next day they're taking a position on the monthly chart, and then they're back on the 1 hour chart. It's just a mess. So if you're a swing trader, you're looking at the 1 hour, the 4 hour, and the daily most of the time. Again, a scalper, you're looking at a 1 minute, a 5-minute, and a 15-minute chart. So again, be specific. If you want to have a trading career where you trade for a living, then scalping, day trading, most suited to you. If you want to have that time freedom, sort of hands-off approach to trading, then swing trading or position trading would be more suited to you. Now, we also learned that there are 3 types of analysis, which are technical, fundamental, and sentiment. Now, our main focus is technical analysis. So I'm a swing trader with a technical-based approach. Now, this does not mean you should ignore fundamental analysis or sentiment analysis. Actually, combining all 3 can give you a more diverse approach to the market, and there are many situations where I use fundamentals and sentiment analysis to give me a better view of what's happening in the market at that given time. Now, of course, you don't need to use sentiment analysis, you don't need to use fundamentals. Our strategy is 100% technical, but again, fundamentals and sentiment can give you that little more of an insight, that slight nudge of information that you may be lacking in the technical side. So again, you don't need them, but they can be beneficial in certain trading situations. I would also make a habit, as mentioned before, of using your journal. So again, start off with the basic ones, the PDF or Excel electronic version of the journals I have provided. Again, if you haven't downloaded these, you can get them below today's module. And these will definitely help you stay on track and correct any errors along the way. Now, in our next module, which is Day 5, Japanese Candlesticks, we will be learning the introduction to Japanese candlesticks, followed by single candlestick formations, dual candlestick formations, and triple candlestick formations. So it's a packed module. I can't wait for it. I hope you guys enjoyed Day 4, and I'll see you on the next video.